Hello and welcome to Bar Snacks. In the last video I talked about Warren Buffett's company Berkshire Hathaway, how it's got the most expensive stocks in the world, and I talked about quirks about its Class A and Class B shares. Since then, I've read Warren Buffett's Bible, the first book he ever read when he got into investing, Benjamin Graham's The Intelligent Investor. A 600-page tome, this massive volume tells you everything you need to know about Benjamin Graham's special ethos and philosophy around investing, namely what he calls defensive investing. Ben Graham lived from May 9th, 1894 to September 21st, 1976, and he's most widely known as an investor and an economist. His philosophy focused on buy and hold for the long-term investing, very different from speculative trading that you see in films like Wall Street, where Gordon Gekko drops loads of stocks and purchases loads of stocks simply at a whim. He was all about doing it right the first time and holding on to make money for the future. Graham is known for his strategies to have been accused kind of being too safe and very boring, but ultimately having steady growth and reliable gains for the long term. Here's one of my favourite quotes from his book. Once you lose 95% of your money, you have to gain 1,900% just to get back where you started. And it shows how getting caught up in those speculative activities and in bubbles such as the dot-com boom and Bitcoin and things like that, you can really get stuck in a rut if you hold on to your stocks too long and you didn't do the proper research and just got caught up in the wave of popularity. The basic building block of his intelligent investing is this: only invest in quality common stocks and high-grade bonds. Don't invest in anything that's highly unreliable. You don't know, or you haven't done the research about it. It's untrustworthy. Basically, stick to these things that you know and you can think of. He advises in the most basic way for there to be a 50-50 split between high-grade bonds such as government bonds or well-trusted municipal bonds and high-grade common stock, leaders in its industry with a long history of paying out dividends and steady business and profits and slow but steady and reliable growth. The first task of an intelligent investor is to do research properly about the market conditions and the environment that they're investing in. And Graham allows for, with sufficient research, to shift from a 50-50 ratio between 25 and 75 and 75-25 the other way of bonds and common stock. It's just up to you to look at rates on interest bonds, current inflation, stock market growth, hype in the stock market, bubbles in the stock market, and to find the best ratio to suit the market conditions. For example, in the latest edition of the book I read, which was published in 1971 with commentaries from 2002-2003, the market rates for bonds had suddenly become very high and rates for stocks were not doing so well. So Graham therefore advocated for a greater percent of the portfolio to be made up of high-grade bonds. So let's break down what Graham sees as good common stock investment. So firstly, a common stock portfolio should be made up of between 10 and 30 different stocks for adequate diversification and risk-bearing purposes. Each company should be of sufficient size, prominent in its field, and also in good financial condition, under good management, and with a long history of growth and profitability. Ultimately, and this is where the intelligence part of it comes in, it's up to the investor themselves to decide what counts in these measures. How do you define a company that's large, prominent, and conservatively financed? Well, you have to decide for yourself. You can take advice from brokerage houses, you can take advice from the press, take advice from the news, but it's ultimately up to the investor to not get carried away with hype and trends and to stick to the companies that fit these descriptions. Chapter 8 is probably the most memorable point of this entire book, as it talks about how the intelligent investor can deal with market fluctuations. As is often seen around in films about finance, in films about Wall Street, what you can see is huge volatile price swings, instant buying and selling, and when prices go up, people buy, and when prices go down, people sell. And now, if you really think about it, there's a proper logical inconsistency there. If something's getting more expensive, why would more people buy it? And if something's getting less expensive, why would people rush to sell it? And it's all got to do with that following the market and the psychology. If you know that a certain stock has a tendency to fluctuate like that, you should snap it up really when it's at its lowest and not jump on the market if it's having a rally. If it's one of those growth stocks that's popular and speculative, you should not hop on it when it's having a massive rally, it's bullish and it's going all the way up. An example of snapping up a company when it's at its cheapest is Warren Buffett himself, actually. He owns a lot of Coca-Cola, and he snapped up Coca-Cola right after the disastrous release of New Coke. This was when they released a new recipe for Coke, and Pepsi were like, oh, Coke have tried to make Coke taste more like Pepsi with New Coke. There was disastrous publicity for the company, and accordingly stocks fell. And that's when Warren Buffett saw fit to snap up as many shares of the company as he could, because Coca-Cola was a very solid company, had been there for years, was definitely large, prominent, and well-financed and well-managed. So it was definitely a good one to invest in, and he got it at the cheapest price possible. On the subject of market valuations, fluctuations and price, you start to get into quite a central tenet of what stocks are good to invest into, in Graham's point of view. We have the key statistic, price over earnings, which is essentially the price of the stock over the earnings from the share of the stock. Graham advocates that no stock you invest in should have a P over E of 25 or higher. Essentially what that means is that the price of the stock has to be justified by the earnings behind owning it. Otherwise, it's simply not your time. For example, in the dot-com boom, when a lot of technology companies were really growing, there was serious optimism and thought that technology was going to be the way forward and we should all invest in this now because it's going to be worth so much more in the future. It was common to see price over earnings ratios like 75 or 100. Even up to 100. And these would be huge red flags for an investor who had done his research and looked through the stats, looked at the figures and realized that this was not stable earnings, that this was too volatile, too speculative, and not something to invest in. One of Graham's most fantastic allegories is present in chapter 8, and that's of Mr. Market. So let's say that you have a bar of gold at home, and each day Mr. Market comes and knocks on your door and tells you how much he thinks that bar of gold is worth, and you can sell it to him at that price if you want. He's going to accept it. Now, would you put any emphasis at all on what this lunatic who's coming up to your door every day is telling you? No, of course you wouldn't. Of course you wouldn't at all. You would take what he's saying with a grain of salt. But that's why not taking that much from the market price is so important. You've got to not worry yourself with how a stock does just on the market. You have to be more concerned that because you are an actual owner of this business who is profiting from the business and not from the market price. And it's much more important about what the business is doing than what the market is doing with your stock. And you can see how the analogy of Mr. Market plays so well into how he thinks you should treat the market. Frankly, with a bit of a grain of salt. Another great bit of this book is when Graham is talking about investing in index funds, which basically hold a whole range of stocks that then you can invest just in the fund, and then you have, by way, invested in all those stocks. So for an example, there might be an index fund that mirrors the Dow Jones Industrial Average. So basically it holds all the stocks from the Dow, and you can invest in that, and subsequently you don't have to go out and invest in all these different stocks. You can just do one investment. And he really summarizes very succinctly and quite cleanly here. This is one of my favorite quotes I've ever read in a book, I think, is that why look for the needle when you can own the whole haystack? And that's a really great quote. Basically, why go out and do all this research and devote all this energy and time to finding that one stock that you can be sure is a sound investment, when you can invest in an index fund and essentially just average and find that little needle without having to do any of the work. Because ultimately, he reminds us in chapter 15 that in the long run, all common stock doesn't keep up with the stock market as an average. The S&P 500 or the Dow Jones Industrial Average, no stock has just kept up with the average over time. So if you invest in an index fund, you can see that you'll be keeping to that average. And although you might not do quite as well, for the investor that doesn't have a lot of time on their hands, investing maybe isn't their main job, maybe this is a side thing for them, investing in an index fund, see, it's very helpful. Graham is also sure to pepper his book with many examples of how analysis can be added to a company to find whether it's a great investment. He essentially picks stocks like that are next to each other alphabetically in the Dow Jones or the S&P 500 or something like this, and shows how analysis can be applied. So you can see that his methods really do work. Ultimately, it's all about protecting yourself against risk, making steady, slow profits, and being intelligent and aware, doing your research about a company, looking at its assets, looking at its finances, questioning whether there are problems with its finances, and ultimately making the best investment. Warren Buffett read this book when he was 19. It was the first book he ever read about investing. And to be honest, from my own reading of it, it really holds up as the most thorough, the most comprehensive, the most well-researched, and probably one of the most fantastic investment books I ever will read. Anyway, thank you. It's been Bar Snacks. I'll see you in the next one.